How to Invest Your Money in Your 20s, a Smart Beginner's Guide. Your 20s are an exciting, chaotic, and formative decade. You're figuring out careers, relationships, housing, and if you're lucky, starting to earn real money. While it's tempting to spend that first paycheck on fun, learning how to invest in your 20s could be one of the smartest moves you'll ever make. The good news? You don't need a finance degree or a six-figure income to start. What you need is discipline, patience, and a willingness to learn. Here's how to begin investing with confidence in your 20s. 1. Understand why investing early matters. You've probably heard this before: start early, and let compound interest do the heavy lifting. But what does that really mean? If you invest $200 a month from age 25 to 65 and earn an average 8% annual return, you'll end up with over $700,000. Start at 35 instead, and you'd have just $300,000. Time is your biggest asset. Even small amounts invested early can snowball over decades. 2. Get your financial foundation in place first. Before you dive into investing, make sure your financial basics are solid. White heavy checkmark: build an emergency fund. Aim for 3 to 6 months of living expenses in a high-yield savings account. This protects you from having to sell investments in a crisis. White heavy checkmark: pay down high-interest debt. Credit card debt, often 20% plus interest, grows faster than your investments. Pay it off aggressively before investing heavily. White heavy checkmark: budget intentionally. Create a budget that includes room for both short-term needs and long-term investing. Automate where possible. 3. Learn the basics of investment types. Understanding what you're investing in is key. Here are the most common investment vehicles. Bank stocks. You're buying ownership in a company. Historically, the stock market returns about 7 to 10% per year long-term. Briefcase bonds. You're lending money to governments or corporations for lower returns but more stability. Package index funds and ETFs. Bundles of stocks or bonds that track a whole market, like the S&P 500. These are low-cost, diversified, and beginner-friendly. House real estate. Buying property or investing through REITs, real estate investment trusts. Requires more capital but offers passive income potential. 4. Use tax-advantaged accounts. In your 20s, using the right investment accounts can save you thousands in taxes over time. Money with Wings employer-sponsored 401k. If your job offers a 401k, especially with matching, take full advantage. That match is free money. Moneybag Roth IRA. With a Roth IRA, you contribute after-tax dollars but withdraw tax-free in retirement. Great for young people who expect to be in a higher tax bracket later. Tip: start with a Roth IRA if your employer doesn't offer a 401k. 5. Start small and be consistent. Don't get hung up on needing thousands to start. Many investing platforms let you invest with as little as $5 to $100. Chart increasing: use dollar cost averaging. This means investing a fixed amount regularly, e.g., $100 per month, RIGA. Regardless of market conditions. It reduces risk and builds discipline. Lightbulb: automate everything. Set up automatic contributions to your Roth IRA or brokerage account. What's automated gets done. 6. Keep it simple: go with low-cost index funds. You don't need to pick stocks or time the market. In fact, most professionals can't beat the market consistently. White heavy checkmark: invest in broad index funds. Examples: Vanguard S&P 500 ETF, VOO. Fidelity Zero Total Market Index Fund, FZROX. Schwab Total Stock Market ETF, SCHB. They're cheap, diversified, and historically perform well. 7. Don't panic when the market drops. Markets are volatile, that's normal. The key is to stay invested and keep contributing. The worst move is pulling your money out during a downturn. You lock in losses and miss the recovery. Remember, investing is not about timing the market, it's about time in the market. 8. Explore other opportunities, cautiously. Once your core investments are in place, you can start exploring. Bar chart individual stocks. Fun and educational, but riskier. Don't bet the farm, limit to 5 to 10% of your portfolio. Laptop computer robo-advisors. Services like Betterment or Wealthfront manage your investments for a small fee. Seedling ESG investing. Want your investments to align with your values? Look into environmental, social, and governance (ESG) funds. 9. Keep learning and adjusting. Your 20s are about building habits and gaining knowledge. Follow reputable finance podcasts or YouTube channels. Read classics like The Simple Path to Wealth by J.L. Collins. Review your investments once or twice a year, not every day. As your income grows, increase your contributions. Set annual goals and revisit your risk tolerance. 10. What not to do. Crossmark. Don't wait for the perfect time to start. Crossmark. Don't chase meme stocks or crypto hype without research. Crossmark. Don't invest money you'll need in the next 3 to 5 years. Crossmark. Don't compare your journey to others online. Final thoughts: invest in yourself, too. In your 20s, investing isn't just about stocks and funds, it's also about investing in your skills, health, and relationships. Take that course. Start that side hustle. Build habits that compound over a lifetime. Financial freedom doesn't come overnight, but if you start in your 20s, it becomes not just possible, but probable.